Welcome to the deep dive. We're here to cut through all that noise and really get to the heart of what's happening. Let's forget the headlines just for a moment, the ones flashing past, and ask, what's the actual story driving the numbers in the global economy right now? Today, we're digging into a recent weekly brief from JP Morgan Asset Management. We've got their data as of July 18th, 2025, and insights from July 21st. So really fresh stuff. Our mission really is to pull out the key insights, maybe some surprising facts from this detailed overview.
Yeah, and these briefs, they're quite useful, aren't they? They manage to pull together a lot of different threads. They give you a pretty concise but comprehensive snapshot of the market. Helps make sense of some pretty complex signals out there.
Okay, let's unpack this then. Starting with their thought of the week. The big headline, U.S. core inflation for June. It came in weaker than expected, 2.9% year on year. Now, on the surface, that sounds like, good news, maybe. But what's lurking beneath that number according to the report?
Well, that's exactly it. The devil really is in the detail here. Because while that main number was softer, the report immediately flags something important. Businesses are actually showing signs they're passing tariff costs on to consumers.
Passing them on already.
It seems so.
Yeah.
It's not just theoretical anymore. It's starting to show up in prices. Creates this sort of underlying hum of pressure.
And they give a specific example, right? Something quite relatable.
Yes. They point to a clear uptick in prices for import-sensitive sectors. Household appliances apparently saw inflation get particularly hot.
Huh. So if you're thinking about buying a new washing machine or something, maybe don't wait too long. Sounds like you might already feel that pinch.
Could be. And what's fascinating here is why we might not be seeing the full whack of these tariffs just yet. The report mentions a few things. Businesses, they were front-loading imports, trying to get stuff in before levies hit or went up.
Okay. Trying to beat the clock.
Exactly. Plus, you had existing shipping delays messing things up, and then there's the ongoing talk, the threats of even higher levies coming from the U.S. administration.
Mm-hmm.
So putting that all together, it likely means the full impact, well, it's probably still working its way through the system, yet to fully show up in those price pressures.
Right. So what does this all mean then if we zoom out? There's still uncertainty, obviously, about where tariffs land, how much businesses eat versus pass on.
But despite that, last week's inflation print, even being softer, it strongly suggests there's more upward pressure building for U.S. inflation. It's a trend to watch. Definitely.
Okay, makes sense. Let's pivot now to the week ahead section in the brief. This is always useful, like getting a bit of a roadmap for upcoming economic news, key decisions. Here's where it gets really interesting sometimes. What stood out for the coming week?
Well, they list several things, and this raises an important question maybe. Why do these specific releases matter so much? Just take consumer confidence, for instance. That tells you about sentiment, right? How people are feeling, which affects spending. Then you have PMI's Purchasing Managers Indexes. Those are really key forward-looking indicators that give you a sense of activity or businesses expanding or contracting.
Right, manufacturing, services, the whole lot.
Exactly. And then, of course, central bank decisions, like the ECB rate decision this week. Those directly impact borrowing costs, investment currencies. They can really move markets.
Gotcha. So let's walk through the specifics they highlighted. On Wednesday, we've got Eurozone consumer confidence for July. The prior reading was negative 15.3. And also U.S. existing home sales for June. That was up 0.8% month on month before.
Then Thursday looks like a really busy day.
Yeah, seriously packed. We have the Eurozone ECB rate decision. The prior rate was 2.00%, plus a whole slew of composite PMIs for July. Let's see. Eurozone was 50.6, Japan 51.5, UK 52.0, US 52.9, pretty much all expansionary, but barely for some. And here's one to watch. US new home sales for June. The prior reading was down, and significantly so. Negative 13.7% month over month. That's a pretty sharp drop that jumps out.
That is a noticeable negative change, yeah. Definitely something to keep an eye on.
And then wrapping up the week on Friday, UK consumer confidence for July prior was NIC 18, and UK retail sales for June, which were also negative previously, down 1.3% year on year.
You see how these pieces fit together, though. That ECB decision, the PMI data across regions, they all give us more clues about the direction things are heading.
Right.
They help build that bigger economic picture piece by piece.
Absolutely. Okay, let's shift gears again to the market statistics. We're not just reading numbers here. We're looking for, the interesting movements, the patterns, maybe surprises. So starting with equities. The S&P 500, it had a decent week, up 0.6%. And year to date, it's up 7.8%. Solid. But anything else really pop out from the global view in the report?
Yeah, there was one that really caught my eye. If we connect this to the bigger picture, MSCI China had a really strong week, up 3.8%, And look at the longer term, 23.3% year to date and 38.9% over the past year. That's impressive.
Wow, 38.9% over the year. That's huge compared to the general global market. The MSCI AC World was up just 0.8% for the week, right?
Exactly. Now, the report doesn't spell out every single reason, but that kind of sustained outperformance often points to, strong domestic factors, maybe specific policy actions, or just market confidence that's a bit decoupled from global worries. Definitely shows diverging paths.
Interesting. And what about sectors within the U.S. market? The source mentions technology leading again, up 2.1% for the week. Industrials also up 1.0%. But healthcare lagged, down 1.6%. And the growth versus value thing continues. Growth up 1.6% weekly, value slightly down, 9 to 0.1%.
Mm-hmm. Then moving to commodities. Brent crude, around $70 a barrel, down about 1.2% for the week. Pretty stable, really. But what's fascinating here is gold. It dipped slightly, 0.4% down for the week, sitting around $353 an ounce. But look at the longer view again, up 27.7% year to date. And over the year, a massive 35.9%.
Yeah.
That's quite something.
It really is. That consistent surge definitely makes you think about what's driving it. Maybe safe haven demand, inflation worries, central bank buying. It grabs your attention. Definitely. Okay, briefly on bonds and currencies. The U.S. 10-year yield was at 4.43%. The UK 10-year saw a small rise, 5 basis points, up to 4.67%. And currencies, dollar per euro, around 1.16. Pretty standard stuff there recently.
Mike. And finally, let's quickly look at those macro GDP and CPI figures, because this really highlights a kind of paradox, doesn't it?
Yeah.
You've got these really interesting contrasts. U.S. GDP reported at negative 0.5%, Japan at negative 0.2%. So technically, negative growth in both.
Negative growth, yeah.
Their CPIs, their inflation rates are 2.7% and 3.3% respectively. So economy shrinking slightly, but prices still rising.
Stagflationary vibes.
Well, it raises questions. And then contrast that with China, positive GDP growth, 4.5%, quite strong, but their CPI, just 0.1%, very, very low inflation.
Wow, so completely different situations playing out.
It really feels like different major economies are navigating almost separate economic realities right now. This raises an important question about coordination or divergence going forward.
Okay, so let's recap the core insights from this deep dive for you listening. We started with those hidden inflation pressures in the U.S., particularly from tariffs. That might still be unfolding. That 2.9% core CPI maybe isn't the full story.
Right, the underlying trend seems to be pushing upwards.
Then we looked at the week ahead, the key economic events, the ECB decision, PMIs, confidence numbers, basically your roadmap for potential market movers.
Mm-hmm. Important data points to watch.
And finally, the market snapshot. The standout performance, really, of MSCI China equities, and that continued pretty remarkable surge in gold prices over the year.
And understanding these nuances, looking beyond just the headlines, digging into this kind of detail, that's why it's so crucial. It helps you connect the dots, see how global forces interact, and maybe anticipate what might come next. It makes you genuinely well-informed, not just reactive.
Couldn't agree more. So, thinking about everything we've just discussed, here's a final thought, sort of pulling it all together from the source material. You've got these negative GDP figures for the U.S. and Japan, but still persistent inflation. You've got potential future tariff impacts still looming. How on earth are central banks going to balance trying to stimulate growth or at least stop contraction while also keeping inflation under control in the months ahead?
It's the classic dilemma, isn't it? Push on the growth accelerator or the inflation brake.
Exactly. What does that really tight balancing act mean for the global economic outlook? Something to definitely keep thinking about.